all. Good evening and welcome. I'm Mamta Rawat from the corporate communications team of CareEdge. I welcome you to our discussion today on balancing growth and risks in India's commercial leasing market. We sincerely appreciate your time in joining us for this webinar. We would like to welcome our esteemed guest speakers for today. Mr. Girish Singhi, Co-Chief Investment Officer, Welspun 1. Mr. Govardhan Gedela, Head of Corporate Finance and IR, Mindspace Business Parks REIT. Mr. Kailash Gupta, Group Chief Financial Officer, The Phoenix Mills Limited. Mr. Kaushik Shah, National Director, Occupier Strategy and Solutions at Knight Frank, India. This session will be moderated by Divyesh, Director at CareEdge Ratings. We will commence the session with a presentation by Amit Chanchalani, Assistant Director, and Priyanka Rathod, Analyst at CareEdge Ratings. This will be followed by a panel discussion and a Q&A session. In case of queries, panel participants are requested to key into your panel. We will take up your queries at the end of the discussion. Now, may I invite Amit and Priyanka to make the presentation.
Yeah. Thank you, Mamta. Good afternoon and a very warm welcome to the esteemed panelists and participants attending this webinar today. I am Amit Chanchalani and today I will present Care Ratings perspective on India's commercial leasing sector, focusing on the office, retail and warehousing segments. So in this presentation, we'll cover the supply absorption and stock for each segment, along with the key trends driving leasing activity. For each segment, we'll discuss the operational and financial performance of major players and business outlook, followed by CareEdge's rating dispersion and credit ratio of leasing segment. So India's commercial leasing sector is evolving with strong growth across key segments. The country's appeal as a hub for global capability centers called as GCCs remains strong with over 1700 GCCs employing 1.9 million professionals. This combined with adoption of hybrid work models which are driving demand for flex spaces are expected to push office stock to exceed 1200 million square feet by 2028, up from nearly 970 million square feet currently. Private equity continues to fuel growth in office and warehouse spaces, supported by GCC growth and manufacturing focus. In the post-pandemic era, the focus on sustainability is increasing, with green building and energy efficient spaces becoming more desirable, leading to growth in green certified stock and green leasing. CareEdge ratings analysis on sample set of leading players in each segment shows vacancy rates expected to remain low, with office vacancies staying below 15% and grade A malls and warehouses under 10 to 12%. Debt coverage metric like debt to EBITDA or PBLDT ratio is expected to stay below 5.75 times for office and warehousing segment and under 3 times for retail. Lastly, with stable debt protection metrics and positive work market fundamentals, the outlook for India's commercial leasing sector remains robust despite global uncertainties. Now let's have a look at macroeconomic picture. So India's commercial leasing market is benefiting from strong macroeconomic fundamentals and government initiatives. While global GDP growth is expected to hover around 3%, India's GDP is poised to grow over 6%, driven by manufacturing and services sector. Additionally, controlled inflation supported by government policies strengthens business confidence. Key government initiatives like Gati Shakti Plan, progressive FDI policies, and incentives for warehousing are boosting leasing activity. With recent announcement of establishment of the national framework for GCCs, Tier 2 cities are favorably placed to witness demand for Grade A office spaces. The production-linked incentive scheme supports India's position as a global manufacturing hub, spurring demand for Grade A warehouses nationwide. Additionally, rupees 1 lakh crore urban development plan in the 2025-26 budget is likely to contribute towards creation of new retail and commercial hubs. The ongoing policy support highlights a favorable ecosystem, ensuring continued leasing momentum. Now let's look at the trend of private equity investment in the sector. PE investments in Indian real estate rebounded in 2024, growing by 32% year on year, following a dip in 2023 due to global economic uncertainties and a high interest rate scenario. The warehousing sector led with 45% of total investments in 2024, surpassing the office sector, which has been at the forefront since 2018, reflecting increased focus of PE players towards logistics infrastructure. Despite lower office investments in 2024, it remains a long-standing preferred asset class. The PE investment pipeline remains robust, particularly in warehousing, office assets, and data centers. Having looked at broad macroeconomic indicators and PE investments across the segments, now let's take a closer look at each segment individually. Starting with office leasing segment, so in the given chart, as one can see, the Indian commercial office leasing market reached a milestone in 2019, surpassing absorption of 50 million square feet, driven by high institutional investments and IT sector growth. The pandemic slowed momentum in 2021, causing reduced absorption and higher vacancies. However, the market rebounded in 2022, fueled by the rise of GCCs, demand for flex spaces, and continued interest from the IT and BFSI sectors. In 2024, leasing activity exceeded 70 million square feet, strengthening India's global business presence. Additionally, growing economic confidence and revised SEZ rules allowing floor-wise demarcation have further boosted demand. CareEdge ratings project supply at 65 to 70 million square feet with occupancy at 60 to 70 million square feet for top 8 cities in next 2 years. As already discussed, owing to strong occupier demand, India's office stock is projected to exceed 1250 million square feet by 2028. South India, comprising of Bengaluru, Hyderabad, and Chennai, will continue to dominate the commercial office market. Bengaluru is set to maintain its lead due to its large talent pool and thriving IT and startup ecosystems, while Hyderabad and Chennai are expected to gain momentum with significant infrastructural developments. From 2016 to 2020, the stock for top 8 cities grew at a CAGR of around 7%, with southern cities seeing a similar growth rate. In the subsequent 4 years, southern stock grew at a CAGR of 7%, while the pan India grew by 5%. As of 2024, Southern India accounts for 45% of total office stock, a share that is expected to continue growing. Vacancy rates, which spiked to 17% in 2021, have steadily improved due to growing absorption, currently standing at 15% in 2024. Going forward with robust anticipated demand, vacancy is projected to decline to 12 to 13% by 2028. While transaction volumes have grown, rentals are also moving up across all markets, with 2024 being the third consecutive year of positive growth. Among the top 8 cities, Mumbai commands the highest rentals, with rental transaction in some areas going as high as 700 per square feet per month. Leading the trend, Bengaluru reports a 7% rise, driven by strong demand from tech giants and a thriving startup ecosystem. Delhi NCR has also seen a steady rental increase with rising demand from IT and consulting firms. Looking ahead, rentals are expected to continue rising in the near to medium term, supported by higher construction costs, increased investments in sustainable buildings, and rental escalations. Let's have a quick look at the key trends that are influencing office leasing. The hybrid work model continues to shape leasing decisions as companies balance space optimization. Another trend that we look is flex leasing, which is gaining traction with occupiers preferring managed spaces and short term commitments. As shown in Exhibit 5, the top 5 co working players expanded capacity by 94% from FY22 to FY24, with occupancy steady at 80%. ESG considerations are rising, with businesses prioritizing green certified buildings and wellness focused workspaces. As discussed earlier, GCC remain one of the key demand driver. However, the global slowdown has impacted IT hiring in recent years, with AI further influencing employment trends. Accordingly, the demand from IT sector remains a key trend to monitor. Lastly, space consolidation by large corporates for cost efficiency may boost demand in emerging leasing hubs. Having reviewed the overall performance of office leasing segment, let's now delve into the financial performance of key players. So Care Ratings has analyzed a sample set consisting of REITs and large corporates together holding office stock of over 150 million square feet. Over the past 6 years, REITs have seen significant stock expansion, growing at a CAGR of over 7%, while non-REIT stock grew at a lower CAGR of around 5%. Looking ahead, there is a strong pipeline for REITs, and with a healthy REIT-worthy stock in India, the stage is set for continued expansion. Occupancy rates for this sample set stood at a healthy 88%, showing steady improvement after a dip to 85% in FY21, which aligns with the overall sectoral trend. A key driver of demand in Indian office leasing has been near dollar rents. While average rentals were below dollar equivalent values until FY23, recent years have seen an increase driven by rising construction cost and preference for green sustainable buildings. Despite the upward movement in rentals, Indian market remains attractive for global players, continuing to support strong demand. So the leverage profile of the sample set remains stable despite considerable expansion. Over the period, the debt levels of this company have increased from around 46,000 crore to over 70,000 crores. However, rental income has also experienced similar growth, rising at a CAGR of 12%, driven by combination of increased rental rates and expanding leasable portfolio. As a result, the debt to rental ratio remains well below 4.5 times, and the debt to PBLDT ratio is comfortable below 5.5 times, reflecting a healthy financial position amid expansion. Now, I would request Priyanka to take forward the presentation on other two segments of leasing.
Thank you, Amit, for the insights on macroeconomic trend and office leasing segment. Let's now turn our attention to the retail segment. Similar to office sector, retail leasing peaked in 2019, driven by strong economic growth, rising middle class consumption, and urbanization. While the market hasn't yet returned to 2019 levels, a significant growth has been seen in 2023 and the first half of 2024. Notably, supply has dropped to its lowest in 5 years. Premium malls have experienced high tenant turnover, with luxury brands replacing mid tier ones, leading developers to reconfigure layouts to accommodate these upscale retailers. This limited supply, along with strong leasing activity, has driven down vacancy rates and pushed rents up, especially in prime areas. The rise of e-commerce is pushing brands to adopt an omni-channel approach, blending physical and digital retail. Additionally, the growing popularity of OTT platforms is reshaping the cinema experience, causing multiplexes to rethink their strategies. This shift may prompt retailers to diversify their occupier mix to maintain footfall and enhance the shopping experience. Driven by the expansion of global brands, rising disposable incomes, and a preference for experiential retail, India's Grade A mall stock is set to surpass 80 million square feet by 2028, up from around 55 million square feet in 2024. With a strong supply pipeline, we expect over 10% growth in stock by end of 2025. The demand for high quality retail spaces continues to rise as international and luxury retailers expand and consumers increasingly seek experience driven environments. In response, developers are focusing on creating premium retail spaces that blend retail, dining, entertainment, and leisure. Additionally, growing consumption in Tier 2 and Tier 3 cities is driving the expansion of Grade A malls outside major metros, creating new regional retail hubs. Let us now turn our attention to the financial performance of key players in the industrial segment. CareEdge Ratings has analyzed a sample of large companies holding nearly 30 million square feet of Grade A stock. The analysis reveals a strong occupancy level of near to 90% over the past 5 years. During the pandemic, while occupancies remained resilient in operational spaces, the retail leasing was the most affected segment, prompting developers to offer discounts or waive rentals during the lockdown period. However, in FY23 and FY24, we have witnessed a robust recovery in retail spending driven by increased savings and disposable incomes. This has translated into significant rental growth across the sector. While average rental rates were impacted in FY20 and FY21 due to temporary mall closures, they have since surpassed pre pandemic levels and more than doubled from FY20 levels. Looking ahead, we anticipate steady growth of 7% in FY25, with occupancy levels expected to remain strong at over 90% in view of sector's resilience and promising future. Starting from FY21, the retail sector faced significant challenges with rental income dipping by 47% due to the impact of the pandemic and temporary closures. However, from FY21 to FY24, the sector experienced a strong rebound, with rental income growing at double digit rates. This recovery was fueled by a combination of an increase in leasable area and a rise in rental rates. As a result, rental income more than doubled, growing from a low of rupees 2,150 crore in FY21 to nearly rupees 5,300 crore in FY24. In terms of debt, the portfolio has remained relatively stable, with debt levels remaining range bound between 12,000 to 15,000 crore, reflecting a cautious approach towards expansion and debt additions. This prudent strategy has kept leverage manageable. As a result, the debt coverage metrics for the sample set have improved significantly, highlighting the financial resilience of the sector. The key takeaway is that the retail sample portfolio now demonstrates the lowest leverage metrics, positioning it for sustainable growth moving forward. Moving on to the warehousing segment. The warehousing sector has evolved from an unorganized market to an organized segment driven by demand for modern large warehouses and growing PE participation. Strong demand for grade A assets led by 3PL, manufacturing, and e commerce expansion keeps vacancy levels low. The rise of quick commerce is further fueling demand for in city warehouses. Additionally, the recent Union budget's focus on air cargo warehouses is expected to boost logistics infrastructure for exports. However, high land prices are pushing developers to optimize logistics parks. Driven by the rising demand for logistics infrastructure, the total Grade A warehouse stock in India is projected to grow to 420 million square feet by 2028. NCR will continue to hold largest stock among top clusters. As the manufacturing activity intensifies, warehousing leasing is expected to increase in the industrial clusters. In particular, Pune is emerging as one of the key logistics destinations due to its proximity to MMR and supported by its strong manufacturing base, particularly in automotive. Chennai, with its port facilities and manufacturing base, is similarly witnessing substantial growth in warehousing demand. This growth is not confined to just the top clusters, it is extending to Tier 2 and Tier 3 cities as well. The warehousing leasing segment is one of the fastest growing sectors, and as a result, the non InvIT stock in our sample set has more than doubled from FY20 to FY24. Further, the emergence of InvITs in recent years with sizable warehousing portfolios has also contributed to the segment's growth. Despite the significant addition of stock, occupancy levels have remained strong consistently near 90%. Rental rates have been gradually increasing. However, with the rise of InvITs, they are expected to climb further as most stock is built to suit, leading to higher average rents. For the non InvIT stock, we expect steady rental growth with average rates remaining close to rupees 30 per square feet per month. Like the office and retail sectors, the warehousing segment has maintained a stable debt profile with debt to rental ratios under 4 times and debt to PBLDT slightly above 5.5 times. This segment is less vulnerable to cyclical fluctuations and its impact during the pandemic was limited. With continued growth in e commerce, quick commerce, and positive manufacturing prospects, the segment is poised for favorable long term growth. While leverage is slightly higher than the office and retail sectors, the segment's stability and growth potential remain robust. Let us now move forward to discuss the CareEdge ratings perspective on the sector. The left chart provides an overview of the rating distribution of companies rated by CareEdge as of December 31, 2024. Over 85% of the portfolio falls within the investment grade category, that is BBB minus and above, indicating a strong credit profile. Companies in the higher rating categories typically belong to the organized sector, backed by strong parentage and robust fundamentals. The right chart illustrates the credit ratio, which measures the ratio of rating upgrades to rating downgrades over a given period. The data shows a notable improvement, with the credit ratio rising from below unity in previous years to 2 times or higher, indicating a greater number of upgrades than downgrades. A key highlight is that there were zero downgrades in 9-month FY25, marking a significant shift in credit quality, largely attributed to the stable financial performance of players. The office leasing market outlook is stable, with flex space and hybrid work models driving demand. While global headwinds and employment trends require close monitoring, high quality assets continue to attract strong interest, particularly from REIT investors supported by SEZ notification. The warehousing sector has a positive outlook driven by 3PL expansion, rising e commerce penetration, and supply chain optimization. The retail segment also maintains a positive outlook, supported by the growing presence of international brands, D2C expansion, and omni-channel retail strategies. Additionally, experiential retail formats are reshaping leasing preferences, with premium malls witnessing strong tenant churn and repositioning. Tenants will continue prioritizing sustainability and tech enabled spaces while making leasing decisions. With this, I conclude my presentation. Thank you everyone for patient listening. Over to you, Mamta.
Thank you, Amit and Priyanka. Attendees are requested to key in their question, which we will take up after our panel discussion. Now, may I invite Divyesh Shah to take over the session, please. Divyesh Shah is a director at CareEdge Ratings, with a total work experience of more than 25 years, of which he has been associated with CareEdge Ratings for about 18 years. He has worked with the Research and Ratings Division at CareEdge Ratings and is the vertical head of the real estate sector. Divyesh is part of various rating and criteria committees at CareEdge and is an MBA in finance by qualification. Over to you, Divyesh.
Thank you, Mamta. And thanks, Amit and Priyanka, for an interesting presentation. I hope I'm audible.
Yeah.
Good evening, and warm welcome to all the esteemed panelists and attendees for today's webinar. I'm honored to introduce our esteemed panelists in alphabetical order who have taken out time to join us in today's session. Our first panelist is Mr. Girish Singhi, Co-Chief Investment Officer of Welspun 1. Mr. Girish is a seasoned professional in private equity real estate with over 15 years of experience in fund and investment management. He is engineering graduate from Delhi University and holds an MBA degree from FMS Delhi. A very warm welcome to you, Mr. Girish. Our second panelist is Mr. Govardhan Gedela, Head of Corporate Finance and Investor Relations at Mindspace Business Parks REIT. Mr. Govardhan has over 15 years of expertise in strategic initiatives, acquisitions, risk management, fundraising, and investor engagement. An alumnus from IIM Ahmedabad, Govardhan also holds a Bachelor of Law from Mumbai University and a Bachelor of Engineering from Andhra University. Welcome, Mr. Govardhan.
Thank you, Divyesh.
Our third panel member for today, Mr. Kailash Gupta, is the Group Chief Financial Officer of the Phoenix Mills Limited. With over 25 years of experience spanning multiple functions, Kailash is a distinguished expert in finance and strategy. He has received prestigious awards, including the esteemed CACFO Award in January 2018 and recognized as one of Asia's top finance leaders by White Page International in 2022 for his outstanding contributions to the industry. Welcome, Mr. Kailash.
Thank you,
And our
Divyesh.
fourth panelist for today is Mr. Kaushik Shah, National Director, Occupier Strategy and Solutions at Knight Frank India. He has over 18 years of extensive experience in the real estate industry and has worked on diverse projects including formulating entry strategies, acquiring new spaces for relocation and expansion, and managing lease rentals. He holds a postgraduate diploma in family business management from the Narsi Monji Institute of Management Studies. Warm welcome, Mr. Kaushik.
Thank you. Thank you, Divyesh.
So great. We indeed have an illustrious panel with us today to give us valuable insights on the current situation and share their outlook on the commercial leasing sector. Let me begin my first question with Mr. Govardhan. As we saw in our presentation, the office absorption has crossed 70 million square feet. In your view, what will be the key growth drivers moving forward? Additionally, how do you see geopolitical risks and potential global slowdown impacting India's commercial real estate sector?
Yeah, as you rightly mentioned, Divyesh, the last year numbers were just out in January, and it has been a fantastic year in terms of both gross leasing and net absorption. I think India recorded in the top six cities about 70 million square feet of gross leasing and about 50 million square feet in net absorption, and has seen a dip in the vacancy levels, also almost a percentage point on a base of almost 800 million square feet. And this has largely been led by uh, two from a demand perspective. I think two strata, if you would look at it that way, was one was GCCs, which have contributed to nearly 35 to 40% of the leasing activity. And interestingly, the domestic India, the India facing businesses have also contributed a third of the leasing activity. And what's heartening to see is that GCCs which have been setting up shop in India have not only come from technology sector, but from automotive, engineering, research and development, financial services, QSR. A lot of wide variety of segments have been opening up shop in India. Of course, the advantages why they have been coming to India have always been there, be it the cost arbitrage, be it the talent pool, be it the necessary infra in these top metro cities. The attractiveness continue to improve, and I think we have added about 110 GCCs in the last 5 years. So India clearly is seen as the GCC capital of the world. So one was, of course, from the demand side, both GCCs and domestic. The other thing, other aspects that also led to growth in demand was one was the SCC rule change that came in late 2023, that helped unlock a lot of the ideal spaces that was otherwise languishing, and that led to incremental cash flows for the developers who were having SCC stock but not being able to market it earlier. The other softer element would be while the physical occupancies in offices have almost reached 70 to 75% and expected to maybe stabilize or move only a little bit more because of the adoption of more hybrid models. There were a few fence sitters still who embraced work from home model. Even those fence sitters are now moving to, return, calling people back to office, maybe 1 day, 2 day, 3 day. It's beginning somewhere. So that is also driving some space requirements in the overall landscape. And as far as we've seen the recent IT company results, they are all campus hirings continue to be, moving forward in the coming year as well. They've given a positive outlook for campus hiring. So all these I believe would lead to, continued momentum in the office leasing for the upcoming year. As far as geopolitical risks are concerned, I mean, there are few risks that are behind us. Some new risks keep coming. I mean, we had the Ukraine-Gaza issues, which I believe all of us have taken pretty much in our stride now. But of course, the new trade wars amidst all the tariff wars that are going on have come into the picture now. So I think corporates have largely embraced this volatility that's been happening over the last 2 years with some kind of risk mitigation, risk hedging strategies. But yes, because Indian IT and to a large extent Indian commercial real estate has now been dependent on US and European markets, any large scale macro negatives would lead to a disruption in terms of delayed expansions, capital inflows. But right now, I think it's a pretty balanced approach. I mean, things are not looking so bad. It's not a balanced approach to, a cautious optimism is what we would say. And what's happening, as I said, is domestic India is also driving the leasing activity. That's going to help if ever there is a void in the overall transactions.
Well, Mr. Kaushik, if I can also have your view on same risk to office leasing in view of global uncertainties and geopolitical risk. How do you see occupiers strategizing their expansion plan because of this?
On a lighter note, everything that is coming as a negative news in our newspapers, if I just look at the stock market, everything is getting absorbed. and next day morning you read a story that the stock markets are rising, everything is absolutely fine, and it's quite lucrative when it comes to India. Just wanted to, India is uniquely placed at this point in time, wherein if the world does well, the IT spends increase, and so as to the Indian IT companies get orders. And if the world does not do well, uh, there'll be more jobs which are getting shipped to India through the GCC route or through the IT or BPO route. So, wherein you are looking to cut spends, and India is one market where the labor arbitrage is still very high, and now it's no longer labor for the phone, I would say the BPO industry, but the highly skilled jobs, which were at some point in time the talent was not there. You're finding that talent in India also. So in that ways, India is uniquely placed, and whether ups or downs, there are jobs getting created in India, wherein the world is looking at India as a focus market.
Do you see occupiers taking some more time to finalize their office requirements, or in view of all this that's happening in especially with USA?
So there has been, so time and again people take a pause and see where things are moving. 2020, when things kind of came back to where there was COVID, people surrendered space. Uh, as far as Bombay is concerned, it was the least affected when it comes to surrenders, but the IT markets like Bangalore, Hyderabad, Chennai saw a lot of surrenders. Post that, people took up space because they've, recruited people, and at the same time, they're asking people in certain markets, they wanted people to come to office. But they've been cautious in not really taking up some large spaces. Come 2024, I think more or less people have firmed up their office coming strategy, whether it is a hybrid or it's going to be permanently work from office, or 3 days a week, 4 days a week, all kind of combinations, what works best for each sector, each company have been they've come up with. And as a result of which, you see people committing to spaces, and people have been more certain that this is the kind of space that I would require from a at least a 5-year horizon, if I had to plan for. 72 million square foot of space was is unprecedented, and this is the first time ever that office market has seen that kind of an absorption.
Moving to the retail segment, I will request Mr. Kailash to come in here. The retail leasing has shown a rebound in absorption post COVID-19. Are you witnessing any structural shifts in recent times? How do you see e-commerce expansion and global uncertainties shaping the future of retail sector?
I think from 23, I mean 21 onwards, it's completely growing as a sector. One is the not only the because during the COVID the plan could not happen, and the retail assets are available in limit currently, and I see the growth on the construction side is still limited. I think the absorption is increasing because of lot of new brands are entering into the India. Luxury, as you know, is the new buzzword which is happening around, and they continue to take off, during the course of the leasing. Uh, Lot of jewelry brand, the I mean, to fashion to the watches segment. So these are the segment which are growing very fast and rapidly. Earlier, these used to be part of the high street. Now they are moving to the malls. More and more brands are coming up, and surprisingly, the even the takeoff is very high and the consumption is very high. So all these are like a shift. The retailers are also doing a lot of experiment. Where maybe the couple of categories, which are moving out, or especially the resizing of the the I mean the electronic brands to hypermarkets are going out, or maybe resizing, or maybe small size which is available. So I think these are a couple of shifts which is happening, even in the retail sector, and this will finally is finally leading to higher consumption as a segment. Second is it is also leading to premiumization of the entire malls which is happening. Third part is the on the premium malls, especially the demand is continue to grow. I mean, it is not affecting the overall the size which is coming up or the spaces which are available currently. Now, as far as the e-commerce is concerned, I think it will continue to grow. Not that but both the segment, if you ask me, the retail segment as well as the e-commerce, both had a space in the country and both will continue to grow. Because considering the population of 1.4 million people, billion people, I mean, it's uh, it's it's something which where everybody can survive and everybody can grow. And whatever the even the e-commerce is offering, they need a physical store at some point of time, to showcase their product and showcase their brand and everything. I think those are the things which are continuing. So despite the e-commerce is growing, the physical stores are opening, and they, in any case, they need every brand to showcase at some point of time. So this is something which will continue to happen. The global uncertainties, I think it really not affecting us, because the in-house, or the India demand is so high. You are not really dependent, on outside, and every day the new brands are entering to the India. I think this will continue for, at least for next decade or so. So till the time the all the brands comes to India and the consumption story continues, more and more you will see the expansion of the retail segment, which will continue to happen.
Okay. I think e-commerce, with the expansion of e-commerce, warehousing segment benefits. Coming to my next question on the warehousing segment, Mr. Girish, we would like to have your inputs. The warehousing segment has attracted the highest private equity investment, yet rental growth has remained largely stable. Which occupier segment would drive growth going forward, and your views on improved rental rates?
Sure. I think a very interesting question. I'll try to break it into two parts. So when you talk about the warehousing market, we are only talking about the large big box format, right? Where you make large stores in the outskirts of the city, which we call the first mile warehousing, which I'll talk about. But we forget warehousing is actually beyond first mile warehousing. There is port linked warehousing, there are temperature controlled warehousing, there is something called peso warehousing, which are basically essentially used to store hazardous chemicals. And then, of course, the last piece, which is the most interesting, is the last mile, which is where we call grade A urban distribution centers, which is witnessing the maximum growth. And the last segment is the self-storage. So while a lot of this data is not tracked and we focus on only the grade A warehousing or big box, we also need to focus our attention in all this other warehousing segment. So just to give some data stats, right? I think your report mentioned that currently first mile grade A warehousing is about 200 million square feet, and it is expected to grow at 13 to 14% and maybe hitting 400 odd million in next 5 years. And the growth rate is 13 to 14%. But actually, if we compare last mile warehousing, in Mumbai itself, there is demand of at least 5 million square feet of grade A urban distribution centers or last mile warehousing, what they call dark stores. And current supply is less than a million square feet. Imagine that demand supply gap in this segment. This segment itself is expected to grow at 40 to 50% because we are kind of habituated to ordering everything on a button, right? We want everything on 5 minutes, 10 minutes. For that, you need grade A warehousing, you need compliant spaces. Currently, this demand is being serviced by non-compliant and buildings which can't even be called storage units, right? So that image demand will shift, right? Now, when you look at other warehousing segments, like for example, port linked warehousing. For example, we have a large project in the JNPA SEZ, which is called a free trade warehousing zone. Currently, that stock or the port linked warehousing currently is at 16 odd million square feet. That is expected to grow to 40 million square feet next 5 years. So at least 20-25% growth. So to answer your question, which segment I think will witness maximum demand is your last mile warehousing, where the demand is 30 to 40% growth. And there's a huge supply demand mismatch. And the second is a port linked warehousing, wherein there's a huge demand for exim-related demand, for exporting to India, from India to across multiple geographies. That demand is growing, right? Now, to answer your second question, your question on the rental yields and why the rental yields are low, right? So, unlike office, unlike retail, rental escalation in this segment has been actually below par. If you look at the data over the last 8-10 years, the rental escalation have been broadly at sub 3 to 5%. And look, the basic reason is always the warehousing demand used to come 1/3 from 3PL, 1/3 from e-commerce, and 1/3 from retail and FMCGs and FMCDs. But what happened post-COVID is that the e-com demand really slowed down, which is why the rental release went actually lagging, which is why the escalation was not there. Now, going forward, my sense is that the rental escalation will actually be higher, closer to 4 and 5%. And I'll give three data points why I think that will happen. So, as your report actually showed, the grade A vacancies of warehousing is 4 and 5%. And as this vacancy is continuously declining year on year, and as clients are moving from grade B to grade A, as the consolidation of warehousing is happening, this will actually lead to the rental escalation. Secondly, actually, if you also track development yields of bond yields, if you track in the last many years, let's say 7, 8 years, bond yields have been around 7 to 8%, depending on which year you look at. And generally, development yields and warehousing have traded at about 150 to 200 bps premium over that. Now, and there has been no year in which this premium has gone down. Now, to maintain this premium over next 2 to 3 years, you will need to at least witness a 4 to 5% escalation. And lastly, if you look at replacement cost, if you look at inflation, WPI, if you look at construction cost escalations of key raw materials like cement, labor, you have at least witnessed 4 to 5% escalation. Now, if you actually add labor, labor had witnessed 20% escalation. Now, today to build a warehousing, unless you witness that kind of escalation, you will not be able to justify putting additional capital. So combination of replacement cost, combination of long-term inflation, a combination of overall lowering vacancies, shift from grade B to grade A. I do think in the near 3 to 5 years, you'll have catch up on the rental, and the rental escalation will actually move from 2 to 3% to 5 to 6% in the near term.
Okay. Well, thank you. I think I had a couple of questions which I'll ask you again on this execution risk and grade B to grade A. That's an interesting question, at least for the warehousing segment. So thank you. So the big message that we are getting is that the global uncertainties will have some impact on India, as it's a globalized economy. However, India stands out and will see favorable leasing scenario given robust domestic economic growth. Now, taking the discussion on office leasing ahead, Mr. Govardhan, can we have your views? REITs are playing an important role in India's leasing market with about 90 MSF of commercial stock and growing. Would you like to give us some global comparison and learning curve for India?
So I think fundamentally the commercial real estate sector has been doing very well, and REITs are sort of an enabler of this further, because what REITs do is they act as a bridge between the private real estate market and the public financial markets. And because by requirement of SEBI regulations, all the REITs are listed REITs, and listed REITs are subject to rigorous reporting and reporting disclosures, and there's a lot of information that's put out there. It gives a lot of transparency for the incoming investors. It gives them confidence to understand the story behind the business very clearly, and it so much makes it easier to raise capital that could be further used to stimulate development. I mean, it's been a short history for REITs in India so far. While the regulations came way back in 2014, the first REIT came in 2019, and as we speak today, there are 4 listed REITs with about 125 million square feet of portfolio size and about 1.5 lakh crores of assets under management. Compared to this, we have a $2 trillion global REIT market, with US having a significant chunk of it. Almost 2/3 of the REIT market exists in the US. That's because the market has also been very mature. The REITs have started as early as 1960s. Some of the other economies followed suit in the 70s and 80s. Today, at mature REIT markets like US, UK, Australia have almost 90% of the listed real estate in the form of REITs only. I mean, we do hear of a pipeline of few other REITs coming up and getting listed in India. But to get to that kind of size will very well take time for us. And secondly, I think because the concept of REITs and the regulations came only recent decade, a lot of developers have historically been listed as regular companies, listed companies. So if at all companies would want to demerge or list as REITs to create a rent yielding portfolio separately, there could be a transitionary framework that needs to be brought out by the regulator also to enable a seamless transition. And that's something that can probably propel further REITs in India. Apart from that, I think there's another aspect that is required for growth of REITs in India is more investor education awareness. Currently, I mean, if you see the base of REITs is just 2.5 lakh unit holders compared to equity market, where almost pretty much one in every household invests in the equity markets. This education awareness needs to percolate down to everyone, where the REITs are the closest substitute to actual physical real estate. They actually mimic the exact characteristics, the exact cash flows of holding an actual real estate. So as I mean, as time progresses, as awareness grows, I think there will be more REITs being listed, more capital being flowing into this sector, and this in turn will stimulate commercial real estate development. Currently, also we also have only a few asset classes. Of course, India has this distinction of REITs and InvITs. So under REITs, there are only few asset classes. Predominantly so far have been office, retail, some bit of hospitality, and some bit of data centers as part of these integrated portfolios. There are far more other asset classes that can come into REITs. There could be only pure data center REITs. There could be pure residential REITs, if at all. The rental segment of residential picks up, like US has single family, multifamily. Those kind of asset classes can also come. Diversified REITs is another. Diversified REITs are very common in mature economies where the REITs just don't have one asset class but multiple asset classes, which helps in terms of hedging during various economic cycles. So I think there's a long way to go for us, but I think we are heading in the right direction.
Right. I think as our equity markets, our investors mature, and we understand real estate far better. I think REITs should also look. I think SEBI has also come out with SM REITs, which is one more addition to that. So
Yeah,
Mr.
yes,
Kailash,
SM REITs also is again a new regulation for assets under 500 crores. Yeah.
Mr. Kailash, you may agree that luxury brands, as you said, are playing a key role in driving overall demand in the retail sector. Additionally, we are seeing a significant increase in supply, particularly in tier 2 and tier 3 cities. So, according to you, what factors are contributing to this expansion, and how are luxury brands aligning to their strategies to tap Indian markets?
Yes. Basically, there are two questions in this. So one is on the luxury brands, which where the growth is really very high. I mean, if you see overall consumption story, I mean the luxury is the one which is growing by almost 20-25% on year-on-year basis. So this is one of the highest in terms of the growth percentage, while it is size still remain limited because the luxury has started somewhere 4-5 years ago. In the retail sector, and it is growing with a very high pace. So I think this will continue to happen over the period of time, and we are seeing more and more brands are coming to the India. I mean, the chances of that the luxury brand will continue to grow, and the biggest the advantage of it, that the kind of population we have, the every city has some or other aspirational people and who wants to have all these the luxury brands in some or other manner. So that is what the real reason for the consumption. Because if you see the number of malls or number of retail outlets are limited in any city for any kind of retail brand, any kind of luxury brand. So if you have in a city maybe 3 or 4 stores for a luxury brand, I mean it's natural that the people will reach and try to approach those 3 or 4 outlets and try and buy everything. So I think this will continue to grow with the kind of population we have, the aspirational people we have, and the kind of the India is bringing up more and more millennials during this process. So that's one. Second is the expansion in tier 2 and tier 3 city. So we are city like the metro cities are now where we have all the retails available. The people in the segment, actually, if you see the segment which is coming up from the tier 2 and tier 3 cities, that most of these peoples are either so every company, bigger company, or the businesses are now moving to the tier 2 and tier 3 city. So there are a lot of jobs are available, high paid jobs are available to the businesses are growing really well. So all this aspirational class is also now available in tier 2 and tier 3. So people are not dependent on the tier 2 and on the metro city. So even the retailers are expanding in tier 2 and tier cities as well. and there is a good demand in every city. We realize that even the brand which are recently entering into India, if they come to a company of a good size which has a presence in say 7 cities or 10 cities, they are asking them to tie up for all those 10 cities or 7 cities or 12 cities together,
Okay.
rather
Oh,
than going and talking to different retailers at each time, and creating understanding to the contracting, to the leasing rent, to everything. So the tier 2 and tier 3 cities, I think the demand will continue. And there is a huge demand from, you're surprised that there are cities like Lucknow or Indore. These cities are really very aspirational, and the kind of growth number these cities are showing to the retail, I mean, it is unimaginable, and even in couple of cases, it is beating the demand of the metro cities. So I think that segment itself will continue to grow, and the all the retailers or the brands has to go to these cities to increase the consumption or the create a growth path. So I think this will continue as a sector.
I think infrastructure push across India has also helped this tier 2, tier 3 cities to grow and their income levels to rise. We see a lot of, like I track residential as well. So we see a lot of residential demand in these cities, a lot of plotting demand in the cities. And we see now this religious tourism also picking up a lot. So, those locations are also picking up. So income levels are definitely rising. A follow-up question to you again. Uh, OTTs, are rising and they offer some competition to multiplexes. Now, multiplexes are, good. They occupy good spaces in retail malls. So, how do you see this shaping up?
Divyesh, what is happening? There is a lull on the multiplexes side or entertainment side, especially on the cinema side. I would say for last 3 4 years, and in fact, it couldn't take shape up post COVID effectively. So the earlier it used to be a prime anchor for most of the retail places or the malls, and used to occupy normally 10 to 12% of the space. What everybody has started doing because of the low demand on OTT rising, uh, people, one is that they are reducing the size of the overall cinema space in their malls, so they are trying to resizing, or especially the upcoming malls, the size of this occupy, from a 10 to 12% of the total mall size, it is moving towards maybe a 5 to 6% of the size, so that at least number one is they are correcting that space demand. Second piece is there are more and more entertainment options are coming, in every city. So the gaming zone size are increasing. People have a multiple gaming zone in couple of malls now started, making available. They are trying to put everything, live to, all kind of setups, so that the overall the people continue to come as a, for the discretionary spend, not only for the shopping but also as a entertainment options. So this space is, will be definitely resizing or reshaping, over the period of time, and will be replaced by another entertainment category within, on a live to maybe a gaming zone to more and more F&B options, which is not only the food court to, it is moving to now fine dining
Fine dining.
to best of the restaurants, and having a multiple options. So earlier the typically if you see the malls, which were almost a decade prior, I mean, they had normally a one food court with two or three restaurants. Now there are multiple F&B zone in every mall which is coming up. So I think the entire space is replanned, based on the requirements, and this will continue to happen. I mean, it is the same like the earlier the electronics which used to occupy the much higher place to maybe the grocery shops, etc. But this is changing completely. The category will continue to change, based on the demand and requirements.
Uh, One interesting thing, I know you can correct me, is this organized jewelry is becoming a big thing in India. And they will also come up, I think, for a lot of spaces in retail malls. I think the security becomes a big angle for them. So earlier it was highly unorganized, and we now see southern players or eastern players entering other cities. So that they, of course, would prefer high streets, but somewhere I think malls also, or this uh, traditional clothing companies like there's so many, they are also opening largely. Do you see this segment evolving, which was
Of
highly
course.
unorganized? India?
No. I think this sector is more and more corporate players are entering. I mean, recently you see the Reliance to Aditya Birla to Tata, and everybody is already in the space. And so the organized the jewelry will continue to grow, and people prefer also these brands because the reliability or the trust factor is very high as compared to go to a corner shop and buy something, and you realize that because India, the jewelry is not for trading. They normally buy, and it's never sold out unless the person go in some very the bad situation. So, and people have realized over the period of time, if they're buying from the corner shop or the neighboring shop, and when they go for really the selling it or liquidating it, that point of time they are realizing that the value is not even a 40 or 50% or maybe 60% in couple of cases. So at least these brands gives a lot of guarantees to you in terms of the buyback options. These brands also ensure you that the quality parameters and you know using the best of the reputation. So this segment will continue to be more and more organized over the period of time, and like South brand, as you are talking, is really taking a good shape across the country in possibly every mall. So this segment will continue to grow. I think they will be occupying more and more spaces in a mall, and you'll find every mall have at least 4 to 5 brands of a jewelry.
Okay.
And it is really a high offtake in terms of the consumption also, because it suddenly showcase the higher consumption means basically your growth is much higher.
Right. Right. Thank you.
Divyesh,
I
if
think,
I can come in now, if
yeah,
you can actually check at regional players, right? Very local brands like Senco Gold in Eastern, or some in South you have Thanga Malai, some similar.
the South
They are,
have them many.
they're growing very well. They're all clocking 20-30% growth, and they're
Right.
actually also driving the retail consumption in the tier 2 cities. These are not metro stories. The Senco Gold is there in East and all small stories. Similarly, Thangamalai is not a tier 2 story. So that is also, as Kailash like said, it's also actually driving the tier 2 retail story.
It's my personal view. I think India has two. One is India and one is Bharat. And the luxury, like in the cars, we see SUVs seeing a lot of growth vis-a-vis the small end cars. So, there is luxury, premium, fine dining growing. And there is some segment marginally which is hit, which is, so, I hope this budget takes care of that. So there are too many questions. I think the time is one constraint, but Girish, I would like to ask you, and as you were saying, high land cost. So briefly, you can say, we are seeing this high land cost construction expenses, which is there for all the three segments, but warehousing where the rental rates have not moved. So do you see execution risk panning out here? Because there's a lot of supply that is going to come in. And so, yeah, something on land and construction expenses.
You rightly mentioned, so warehousing generally has three sorts of key issues. One is on the capital side and the financing side, which essentially talks about the high land prices, because in good micro markets and generally land takes about 50% or 60% of the overall cost, because the overall construction cost is very low in warehousing compared to other assets like an office or a retail. Well, land is roughly 20-30%, which is why making speculative development makes very difficult in warehousing. Then coupled with your rising construction costs, labor, steel, cement, etc., which is also compressing margin. And the third piece is the high interest rates or cautious approach by lenders, which actually make financing very difficult. Which all of these actually point to grade A players or large players which with strong balance sheets. Now the reason why there has always been a continuous supply in warehousing is that generally warehousing has no zoning limits. For example, any agriculture land across India can be converted into warehousing land by taking a CLU or a conversion. So technically, you have infinite supply. And while the land conversions and the regulatory approvals remain a key bottleneck, and the timeline, etc., can increase holding costs, but you will always be faced with infinite costs. Then another issue which we face is generally, access road. When this outskirt land essentially don't have proper access. So how do you ensure that the last mile access is there? And the last bit on the contractor side, what kind of contractors you use? How do you ensure that there's no labor shortage? How do you ensure that there is no material price volatility? How can you use technology? So there are a lot of challenges which is there. But look, as I mentioned earlier, there are multiple ways you can evade through the challenges. And now I'll talk about what are some of the simple tricks, etc., or not tricks, simple measures which you can use to improve efficiency? Now, we, especially as our strategy, we no longer make warehousing. We say we make logistics anchored mixed use development. For example, when we will make a in-city mixed use development, we'll have it warehousing, we will add some floors of retail, we will have some floors of office, and at the top, we will have F&B. So it will have four asset classes in one. Now, when you do this and when you are able to plan and design well, you're optimizing the land use, you're optimizing the development efficiency, especially by making multi-level warehousing in very high cost urban areas like Mumbai or Bangalore, etc. And you have to maximize your revenue per square feet. Otherwise, there is no, they can make the project infeasible. Now, the second key aspect is how do you maximize the coverage ratios? So there it's entirely design. How do you manage your ingress, egress, etc. But you have to generally projects have 50% to 60% coverage ratio, but in some cities you can go as high as 70%. Then you will have to diversify into high yield segments, right? Now, plain vanilla warehousing, right? Essentially, if you make a warehousing in Bhiwandi, etc., there is no differentiation between a warehouse to a B warehouse. So you will have to migrate to slightly higher yield segments like a port-based warehousing or a specialized free trade warehousing zone or a custom mounted warehousing or an airport linked warehousing where the demand is high, the premium is high, it's trade driven, and you can actually improve your efficiencies and margin. Uh, of course, as you go on the last mile side, if you actually focus on last mile distribution, that can give you higher yields. Third aspect is generally, unlike office, in warehousing, it is slightly risky to make speculative, right? So when you actually select your micro market, you have to have certainty like who will be my tenant, what kind of leases will I get, what rentals can I get, what will be my lock-in periods, what will be my escalations. Those things have to be done beforehand. So generally in warehousing across 3PL, e-com, retail, etc., there are about 40 to 50 tenants. Unlike office, there aren't like thousands of tenants. So you should know their plans, their needs, etc., well in advance. And basis that, you must select a micro market to ensure that you get BTS on day one. Then third aspect is on the cost control. Of course, people use PEB structures and modular construction, which can actually which can lower the cost. But one aspect which people falter is energy. Now, if the maximum effort if you put in sourcing energy through clean energies, reducing your overall operating expenses, that can also reduce your overall expenses. And lastly, you'll have to also think through what is the value that I'm providing. Am I only providing space, or can I provide any automation solution? Can I provide, warehousing management? Can I do a revenue sharing arrangement with a 3PL, or can I do something plus beyond a fixed rental? So unless you innovate both on the product side, but on the efficiency side, on the value added side, that is the only way which will help you improve your yield, improve your efficiency, and increase your returns.
Well, I think I would like to have more discussions with you on financing strategies with you all. But given we are running short of time, we'll take a few questions from the audience. I have one question, and I think Kaushik can have a look at it. It's from a bank. Hi, with companies, especially the larger IT firms, moving towards tier 3 and beyond in order to have an employee base which can be closer to home, therefore helping them attract talent from these towns. Has there been a boost in demand for leasing spaces? Can it be seen as a lucrative upcoming leasing market or not yet?
So, thank you for asking that question. Tier 2 towns and are currently seeing, I would say, post-COVID, they saw some surge in demand, considering most of the employees had gone back to their hometowns. And companies, from data security reasons, wanted them to work in a more secured environment. And if they could provide a facility closer to their homes, and at that point in time, it looked like a permanent feature wherein people may not come back at all. They've started some centers and also trying to attract people from that town from a catchment area. The challenge is that to scale up in a tier 2, tier 3 city is a challenge considering most mid management, the entry segment you would find it will be easier for you to find from the catchment area itself. But most mid management, the moment you rise up the rank for your 5 years of experience, the aspiration for that uh, tier two, tier three guy is to move to a tier one town.
Right.
And at the same time, for you to find adequate tier two management is a challenge. And probably, if you are in a tier one location and you are at a mid management level or a senior management level, it's unlikely that your family would move back to a tier two town, considering you're used to a certain lifestyle, which those tier two towns may not provide. So we were finding those, and then there are these logistical issues wherein let's say if you are a large IT company having 2,000, 3,000 employees, looking at running a night operation. For you, it may be a challenge to find those, let's say 300 cabs for night operations. Maybe a challenge to find in a remote tier three town.
Okay.
So those challenges are there, and most companies, if you see, there are lands which are provided free of cost to big IT majors, but they've not been able to fill up their campuses which they've built. These are spanning millions of square foot, but they've never been able to fill that up.
Okay. I think government is also trying the GCC push and all this for the national
Yeah.
framework for GCC for tier two. I think somewhere de-urbanization or too much of urbanization in 6 cities could be stopped by this way. I have one more question. So it's again from some consulting company, and I think Mr. Govardhan can take it. How sustainable is growth in rental per square feet for next couple of years, considering competition from other Asian nations, Philippines, and others?
Yeah. Compared to other economies, I think India still continues to have those fundamental and structural advantages of good English speaking population, availability of talent pool, good commercial infrastructure, all those, and most importantly, rental arbitrage. I mean, I think recently there was a comparison between a few other GCC countries, few other countries where this outsourcing happens is Romania, Poland, Vietnam, Philippines. India still continues to lead that. I mean, we're still quite far ahead. In fact, there is no other economy which is close to catching up to the scale that India has built in terms of technology backbone that services both their parent organizations or even third-party service providers. In terms of rental growth, that's more a micro market thing. You have many micro markets within India where there is sometimes supply exceeding the demand, or there's far more supply. And there are markets like Delhi and Chennai which have single digit vacancies, or Hyderabad where Madhapur has very limited vacancy, where we are still seeing a strong uptick in rentals there. So it's more of a supply demand equation within those micro markets and infrastructure. If the local governments can take care of infrastructure issues, ensuring there is a seamless connectivity to where these office districts are located. I think India, one of the big challenges is traffic congestion, whichever metro you take up, or whenever there's a monsoon, there's a challenges of flooding. If these issues can be taken care of, and those micro markets can continue to maintain their competitive advantage, and of course the availability of land parcels to bring in new supply, all these factors will weigh in on ultimately how rentals will move. So it largely comes down to micro market equation as to how rentals will grow. At a macro level, I think India is a clear, distinct winner in terms of these advantages that it has.
Okay, great. We have got a lot of interesting insights and trends on the sector. I'm sure the audience too would have also gained a lot from this detailed deliberations. And as we are about to, it's about 5:10, so we'll have to end the webinar. So thank you very much, Mr. Govardhan, Mr. Girish, Mr. Kailash, and Mr. Kaushik for joining us and sharing your expert perspectives. It was indeed a great pleasure to host you and engage in insightful conversations. Mamta, I now hand over to you.
Thank you, Divyesh, for moderating the session, and Amit and Priyanka for your presentation. Once again, thanking all our guest speakers for their insightful views. It was a privilege to host you. And lastly, thank you to all the participants for taking the time out and being a part of this CareEdge webinar. For any further queries, feedback, or suggestions, please write to us in the feedback mail. Goodbye for now. Requesting the tech team to kindly log off.